Hello and welcome to Pro Trader Strategies Market Commentary. My name is Eric Wilkinson from location. Let me get over a disclaimer. Anything I talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, I'm here to teach you some different strategies that you can implement into your portfolios. But please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, let's get it on. Sorry, you guys, been a couple of days since I did the daily market commentary, but been traveling around on the East Coast here. I'm actually in Philly, but I've been back and forth to New York several times. Went and talked with Joe Wisenthal, who is at the Stalwart on Bloomberg, and went and talked to John Malloy, who is John Malloy CNBC, yesterday. So been bumping around to different journalists, talking to them about pro trader strategies and option education, things of that nature. So I've been doing some good things. Was hoping that I would be able to shoot from Bloomberg HQ and CNBC's home headquarters at the NASDAQ, but that didn't quite work out. They were already filming, so my timing wasn't that great to be able to do it. But the week's not over. We still got opportunity, right? So let's get on with it. Let's talk about some economic data that we missed while I was gone. Monday we talked about the ISM, which is the Institute for Supply Management economic data point for the manufacturing sector, and that was a little bit higher. Looking forward to the service side of the ISM, and we got that on Tuesday, and that came out with 58.6, expected to be 57. Now remember, with these Institute for Supply Management PMI numbers, anything above 50 is expansion, and anything above 50 is gravy. So we are getting some good gravy on all these economic data points. So that being said, overall market for equities probably should be moving higher. That might influence the bonds a little bit, but I think that the Fed is going to go one more time this year and then hold off, take a breather, and see how things pan out here, because we're not seeing wage inflation, which is going to affect the ability to pay off things with higher interest rates, like your mortgage. A lot of adjustable rate mortgages out there, interest only. Those type of payments are going to go up with increased interest rates, and that will crimp a little bit of spending. So if we aren't seeing wage inflation offsetting some of these other rising costs, it is going to put a crimp on spending, and that could harm the economy a little bit. Having said that, economic data there is good. We got Great Britain's services PMI on Tuesday as well. Came out better than expected at 54, expected to be 52.9. Then on Wednesday we came out and got our crude oil inventories. They came in at 2.1 million barrel build, expected to be a drawdown of 2 million barrels. So 4 million barrels over the top of what we were expecting. So that is a pretty major build, more than expected. As we can see, it's not affecting crude oil right now, as it is moving higher. One would expect that with that higher supply, less demand would drive that price down. One thing to note, not seeing that happen at the pumps right now. Pumps are still staying rather high, despite the fact that we've had this slide since $73, let's call it. So about a $7-8 slide at any given point. We aren't seeing that show up at the pump necessarily, but crude oil is moving higher, and airlines are taking advantage of it and trying to stick it to the consumer by raising their rates on flights. And gold futures, I'm going to have to do this old school, going back and forth and typing these in one at a time. Gold futures moving up slightly as well. We got a real mixed bag in the equity, so it's not really driving money for a flight to safety type of situation, but we are seeing a little bit of pop in gold, in some of the other commodities, as the NASDAQ is starting to show some weakness, and we'll talk about that here in a minute. While we've got the Dow Jones, and last I checked, the E-mini S&Ps trading in positive territory. So let's check out let's go straight to the VIX and take a look at it for what's happening with the interest rates here, or interest rates, Eric? What are you talking about? With the equities, as we can see, it's moving a little bit higher, but we are stuck down there in the 12s like we were all last year. We don't want to see that. We want to see some high implied volatility in some of these stocks, and the way to get that high implied volatility is to jack up the VIX. So Would like to see some of this move higher. It is moving higher, probably based on the fact that we're seeing this tech sector sell-off, maybe even a rotation into blue chips going on today, and don't want to get into the bad habit of shrinking that, but let's go on to the overall equities. We'll take a look at the Dow Jones Industrial Average, try and keep it in line with what I normally do here. And Dow Jones Industrial Average, as you can see, is up over 100 points. A little bit ago, we were trading near the highs of this, and I said, you know, if we come off about 100 points from the 150 area down, 100 points, that's going to make that look like a little bit of a topping area, all right? And the only reason why I'm starting to come up with this, because if we take a look at the Dow Jones and throw this a little bit, take the Dow Jones off and go straight to the NASDAQ, take a look at the NASDAQ here, because the NASDAQ is the one, like I said, is coming off, and quite dramatically, to be quite honest, over 60 some odd points, but it is landing right on this 50 Fibonacci extension level. That is a major support. We've seen it bounce off of that before. A settlement below this 50 Fibonacci is going to make me believe it's going to want to go at least to the next Fibonacci level right here, because that's where the most time and volume has been spent most recently, and that's where the market is a little bit more comfortable. So the further away from you that spot you get, the more it wants to kind of revert back to it. We haven't been away from it for very long, but a settlement below that 50 Fibonacci, I believe, is going to make the market want to roll over a little bit more and maybe back down into this little comfort zone that it's got going. And then we can take a look at the E-mini S&Ps on the chart, and they have just started going into positive or negative territory. They were just positive a couple of minutes ago, right when I started to do this, but it was only about a point and a half. It's sold off and now in negative territory by about a point and a half. So pretty much unchanged there, but we're starting to see what I was talking about with the now that Dow Jones moving 150 points higher and the NASDAQ down 60 points. That really leads one to believe that it's more of a sector rotation to me and people wanting to get into blue chip stocks right now. So whenever you see those big money managers moving that money, that's how we're going to see something like that happen, and I think that's what we're starting to see show up here. So the E-mini S&Ps, the Dow Jones, and we could look at this on a daily chart, but I don't really have that set up right now for the breakdown on the 30-minute chart. I don't think it's going to look very good. If I do that, I don't think it's going to show up like I have it set up at home, so it's going to kind of be a very long chart there, so it's not going to give us a whole lot of more information that I usually like to see out of that market profile in those type of situations. So that's about it for today. I haven't added any trades or taken them off since I've been on vacation. I am keeping an eye on the market and looking for a couple of things, especially for today and tomorrow. I'm probably going to be implementing a couple of trades that I talk about in this webinar that I'm going to be doing today on the long call calendar. And this is a great one when we're coming out of earnings to set ourselves up for the long road in the next couple of earnings cycles ahead of time. Maybe a good time to start doing this with some of these blue chip stocks as the economy starts to roll. We would expect to see better than expected earnings and things of that nature down the road, and more robust economic data that could drive some of these blue chips a little bit higher, and that would benefit our long call strategy for the calendar would benefit nicely in a situation like that. I'll show you how to set that up to increase your probabilities of success today at 4:15 Eastern. Hope you guys can make it right after the close and show up. We'll talk about that and any of your questions that you guys may have. I know you can go online and figure out how to do a long call calendar spread, but they are not going to give you strike location. They're not going to tell you the reasons why you need to have certain strike locations. Those are things that I learned on the floor that I'm going to teach you guys. So show up for that thing, take advantage of it, and if you can't take that, take it easy.